All right. Hello, everybody, and welcome to another Capital Gains Tax Solutions Mastermind, where every single Friday we are jumping into the deferred sales trust and ways to grow your wealth using it, defer capital gains taxes, help your clients, friends, and family do the same. We believe that the biggest challenge when it comes to exiting highly appreciated assets is not having a clear plan and having a clear understanding of what strategies can work for your exit of highly appreciated assets. And that's where we're going to be diving into a couple of the biggest objections we're seeing when it comes to the deferred sales trust. And we want to help you overcome those objections so you can have what we call sleep well at night before you close and when you close on the deferred sales trust, knowing that you're in good hands. And it has to do with the IRS scrutiny and the complexity issues with the deferred sales trust. And so we're going to try to make that really simple for you right now. And so let's start with this. With the deferred sales trust, it does offer some compelling advantages, especially when it comes to capital gains tax deferral and financial flexibility, which is why it's so attractive because of the flexibility. We believe right now, flexibility and options, along with diversification, liquidity, is the way to grow wealth in a very effective way and not having to feel trapped by capital gains tax to not be able to invest into certain deals. And so that's what the deferred sales trust is so unique. However, like any financial strategy, each have their own set of challenges, and it's not a one size fits all. And there's also objections that people can often cite. And so we want to go through some of those objections today, having to do with IRS scrutiny. So people worry about the IRS disapproving of such structures, right? Potentially leading to fines or other legal ramifications. The unique part of the deferred sales trust is it now has close to a 27-year track record, almost 30 years going on of a perfect track record. What does that mean? That means thousands and thousands and thousands of closes, billions and billions and billions of assets sold using it, and over 24 no change IRS audits. So that means it's been tested, it's been looked at. These are state and federal audits without a single change and a single deferred sales trust, which is actually really remarkable. And so it has faced IRS scrutiny. In fact, we have other competitors that we go up against, and the number one question we ask all of them, because sometimes they are less expensive, and maybe they're even more flexible without a third-party trustee, and all of these really cool things. We call these the magic trust, and we're like, wow, that sounds like a magic trust that you can really have all the things and none of the bad things. And we ask them the first question, well, what's the IRS scrutiny you've been through? And most of them, they just haven't faced it, and or they haven't been around long enough to face it, and or they don't think they're going to face it, which is actually the worst answer you could have when they say, oh, well, it's outside of the IRS. Well, you don't want to be the one who gets tested where they say it's actually inside of the IRS. And so with the deferred sales trust, we fully report everything. We help you to report it properly with your CPA. Any income that you receive, you'll pay tax on, that's reported. And so it's the most important thing that the IRS scrutiny has been tested, and it's been scrutinized, and there's been third parties as well with the deferred sales trust. There's national law firms, CPA firms, former IRS agents, big financial planning institutions and planners, and on and on and on it goes. It's been tested, it's been tried, and so far batting 1,000. That doesn't mean that some law may change, although we do believe that the law is sound. It's IRC 453, known as an installment sale, and that installment sale can partner or can be combined with the trust, and it can purchase assets such as the one you're selling and issue you a promissory note to pay you slowly over time. And that's the key to understand, that just an installment sale with the trust. Now, what about regulatory changes? Like legislation can change, making the DST less advantageous or obsolete. One of the biggest objections, or one of the more of a minor objection, someone would say, well, is it just better to pay the tax now, right? Because isn't taxes just going up, right? I mean, the rates seem to be going up because government continues to spend. We definitely agree that rates are most likely to go up. That's part of the challenge right now that we're in, is overspending with the government and them looking for ways to pay on the national debt. And so that increase in capital gains tax rates, we do think is going to be a big challenge here. However, we use the rule of 72. Regardless of those increases, most of our clients are structuring the promissory notes on a 10-year term where they're taking partial interest or full interest payments, and they're not actually dipping into the principal. And we're using the rule of 72, which states that we can earn 7% net of recurring fees we can double the amount of value of anything. So if it's, let's say it's a $5 million exit that you would have paid 2 million of tax, so you would have had 3. Well, if we can keep the full 5 in there, earn 7% interest over a 10-year term net of fees, well, that 5 million becomes 10 million. It doubles. And that's really what most of our clients are looking at. They're looking for the cash flow to free up their time and their energy. And they'll live off, let's say, 6 to 7 to 8 to maybe even 9% compounding rate of return on the 5 million. That's their cash flow. They'll live off partial interest or full interest payments. And at the end of the 10 years, to define a win here, that full 5 million is still there. In other words, they have not paid any of that 2 million. It's been in a deferral state. It's been working for them. Another way to look at that, it's like a interest-free loan from the government. And that's pretty cool, right? If you can use the government's money that is owed to them, but it's in a deferral state to grow your wealth and live off the cash flow. Now that cash flow you do pay tax on, you'll get a 1099 INT, but that is the whole concept there. And so if you have $1 million net proceeds and $1 million gain, we have found that it's a home run if we can achieve some of those returns. So now that is an if, or we need to be able to achieve that. So we're going to work with you and with financial planners and with real estate experts and develop a team. And that's the first thing to understand is once you have a tax flow mindset, then you want to combine that with the cash flow planning and try to the DST becomes that linchpin in between that helps you to keep the tax deferred and the wealth to grow. So those are 2 things. Let's talk about the complexity, right? So some folks say, well, it just seems like it's too complex, right? Understanding the structure. The DST is more complicated than traditional methods like the 1031 exchange, requiring more education to fully understand. Well, we think this is true. Part of why we think it's more complicated is because there's 5,000 QI companies out there that are banging the drum with the 1031 exchange. And by the way, we love 1031 exchanges. I'm a commercial real estate broker, multifamily broker, started at Marcus & Millichap, has sold about $500 million in commercial real estate and DST transactions. So we love the 1031s, but we hear it all the time. And it becomes kind of second nature, kind of like an IRA or a 401k. The deferred sales trust is not any more or less complicated than any of those other 3 strategies. It's just something that you don't often use or have heard of because there's just a few of us that actually know how to do this. And it's combining an installment sale with a trust. Now, there is a complexity in the sense that there's a third-party trustee, but it's not unlike a third-party qualified intermediary where the funds go to this third party in order to keep the tax deferred, and you follow certain rules. In the 1031 exchange, you have a 45-day to identify, 180 days to close. And in that order, you follow those rules and you stay in compliance and you fully report. Guess what? You get to exercise the 1031 exchange. Same concept with the deferred sales trust. You send it to a third-party unrelated trustee company, that's Capital Gains Tax Solutions, and a third-party trust that's set up just to do business with you, by the way. That actual trust only does business with you. It's a new EIN, and it's not commingled in any of my business accounts or even Capital Gains Tax Solutions. It's completely separate. Capital Gains Tax Solutions is just the company to be the trustee over that account. And so we have all of that in place, and we follow certain rules, and we fully report, and it works. And so it's not more complex than anything else. It's just perhaps you haven't had a chance to get to know, like, and trust us, and know, like, and trust the strategy. But once you do, I think that the complexity is going to go down, and you're going to feel better. People talk about paperwork and procedures. Setting up and managing the DST can involve substantial administrative effort and due diligence. I think that's for sure. That's something there's some, especially in the beginning, it's like a heavy lift, right? In the very, very beginning, it's setting up the accounts. It's setting up the structure. It's exiting an asset into the structure. Now, I think this gets a little bit blown out of proportion because it's coupled with a big exit, right? So emotionally, you're selling a 5, 10, 20, $100 million business, and there's partners, and there's debt to pay off, and there's mergers and acquisition, and there's attorneys, and there's all of these moving parts. And it's like the Super Bowl for your financial exit, right? And it's all coming down to the wire. And then you're adding this DST to it. By itself, the DST is not that complex, but given the circumstances of the emotional heightened sense here, it can become, you can feel like it's more complex than it is, but it's not when you break it up into pieces. And that's what we're trying to do. We're trying to make this simple for you. We're trying to help you to get through the complexity issues and challenges, and help you to close on the deferred sales trust so you can sleep well at night. That being said, I am joined by some amazing strategic alliances. that are here to also help me to make it simple. One in particular is Jake Miller. He is a certified financial planner and so much more. Jake, how are you doing today, sir?
Hey, Brad, doing wonderful, having a fantastic time. I'm here in Utah, loving life and having conversations every day with somebody who's selling something. Sometimes it's something small, sometimes it's something enormous. Sometimes they're the only owner, sometimes there's lots of owners. And the nice thing is that I would say 99% of those conversations, we're talking about the deferred sales trust.
Absolutely. And Jake, what would you say the biggest idea would be for someone to overcome the complexity issue? We'll start with that one, right? So they're saying it just seems like it's so complex. Like, how would you help them overcome that?
Yeah, when you say idea like hurdle or biggest objection or whatever, right? One, why haven't I heard of this before? And in response to that, oftentimes we ask, well, how many times have you been through this before? And the current people who are advising you today, how many others have they helped out with the same situation? So like if you're experiencing this big transaction for the very first time in your life, it's possible that your current advisors that do the day-to-day accounting or the annual tax return, they haven't done this once in a lifetime huge business sell. Or maybe they have, but they do it maybe once a year. Where in fact, Brett, you and I and Jake Carpenter here on the call, we talk with perhaps dozens of people every single week, 52 weeks in a year. And how many years have we been doing this? So we've literally had thousands upon thousands of conversations and discussions over how a deferred sales trust does or does not work for different people in their scenarios and situations.
I think that's so well said. And it's so succinct there, right? That the very fact that certain folks are learning about this for the first time and or are just either, I don't want to say dabbling is the right word, because CPAs, they have so much on their plate and they might have 12 to 24 different top line major things, right? And They can only go so deep on certain things, and it's can be overwhelming. And a lot of times too, we found that folks are bringing this stuff to their CPA sometimes last minute. In fact, it can be tax season. Tax season is right now we're in it, and it's like, oh, did I bring it to the CPA? Is it too much or going to complicate it? And the CPA is going to be resistant because they haven't talked to us, or they don't really know about it, or they think they know. We have found though, and Jake Carpenter, maybe you can dive in here, that when the CPA does come on and talk with us, Jake, what do you feel like the outcome is when it comes to that?
Well, it's quite the interesting discovery process for most CPAs. Again, most of them have never heard of it because it's not a box that they can check on their tax return forms. And again, they don't really deal with a lot of liquidity events like that. Most of them have heard of a 1031 exchange, but just short of that, the CPAs don't generally offer any kind of strategies. You kind of have to come to the CPA with those ideas. And so as the CPA, the first challenge is just to get the CPA on the call with Brett Swartz, the tax attorney, myself, Jake Miller, with the team, so they can ask their questions and get the specific answers that they need to understand. And the funny thing is, Brett, you and I have both experienced this, as well as Jake Miller. Once they get to a certain point, they go, oh, okay, yeah, this is just nothing more than an installment sale. And it's installment sale reporting. Oh, I get it. Okay, so it clicks. And then a lot of times what we get is a CPA at the end of the call that goes, hey guys, I've got quite a few other clients that might be able to use this to benefit their situation and defer some of the taxes on some of the other asset sales that they have. So it's a very big paradigm shift that we oftentimes see if the seller is willing to push their CPAs and their professionals, not just their CPAs, but their attorneys, business advisors, M&A advisors. All of them tend to have an eyes wide open aha moment when they realize that this can help other folks that they're actually working with.
Absolutely. And it's actually it's actually a little bit self-serving when we actually have the CPs on, because we have such a high close ratio that if they bring them on, of course, we want their approval. We want their blessing, right? Especially can have that. But you're right, exactly that. They start bringing other folks on. And by the way, you cannot blame the CPAs for being so skeptical. They should be, because they get approached with a lot of things that don't have the track record, they don't have the audit defense. They also think that they're going to have to be the one to defend the deferred sales trust. I was actually just talking with a client today, and I was reminding them that, hey, remember when you go when you go to report this, remember to tell your CPA that they don't have to be the one to defend it if something happens. Like, that's already been proven. Campbell Law is this is a CPA firm and a law firm tax attorney. It's both. And so they're like, oh yeah, that's right. And they work alongside to report it. And by the way, you're reporting on the same form that you report an installment sale on if you're doing a DST 1.0. And that's the reality. It's actually not that complex. It's not that overwhelming if you have the specialists who can execute this. And by the way, if you're liking any of this on YouTube, you can like the video. You can subscribe to the YouTube channel. That helps to spread the information more, so more people can find it. And you search it, Capital Gains Tax Solutions, if you haven't already found that. Back to Jake Carpenter. So Jake Miller. Jake, let's focus on the other part of it, which is the IRS scrutiny, right? So there's complexities. Then there's IRS scrutiny. There's a thing recently called the monetized installment sale that people get these two confused, or they think they're essentially the same thing. And because the monetized has been proven or essentially shut down on the IRS watch list, and it's a reportable transaction and all of these things, there are those that want to lump in the same deferred sales trust who has a perfect track record, right? And it's not on notice. So talk about some of those challenges, Jake, and helping the people get comfortable as best they can with the deferred sales trust.
Absolutely. Well, and let's just talk about what people mostly are aware of. They're aware of what's on the IRS's Dirty Dozen list, and things come on to the Dirty Dozen list and they fall off of the Dirty Dozen list, just like the S&P 500. There's companies that come on and fall off, and it's just so that you understand kind of how that works. In regards to items on the Dirty Dozen list, well, that's what people hear about. And a lot of times they don't know the reason why it's there. It does not necessarily mean that those are bad strategies that would never work, just that those are the most commonly abused strategies. And the DST has never been on that list, the deferred sales trust. Some of these other things like the monetized installment sale, just for lack of better education, there's a lot of people that might confuse and say that, hey, that has a small aspect of the same tax code, which the tax code is not illegal. The IRC is actually the law, or the tax law, or the tax guardrails that we have to work with it. So there's a IRC 453 that has to do with installment sales. That also has a little piece to do with what we do with the deferred sales trust. That is the only correlation. It's a completely different strategy. And within the deferred sales trust, this strategy thousands of times has been implemented and billions of dollars deferred, meaning individuals who would have otherwise had to declare taxes this year because of a highly appreciated sale or a highly appreciated asset sale or stock sale, they didn't have to. Billions of dollars deferred. And what did that end up with? That eventually, anytime based on the law of large numbers, the IRS, something that happens so many times, it gets reviewed, they receive a notice letter for more documentation, or they get an audit, and sometimes a deep dive audit. And the deferred sales trust, Brett, we've done it so many times over the last 27 years since the founder Todd Campbell implemented it, that there have been requests for more documentation. There have been reviews, and there have been audits 22 different times over the last 27 years. And out of those audits, and let's just talk about one specifically, a deep dive audit on a property located on the shore in California, $120 million, foreign owner. So IRS audit, state of California audit. I believe the city wanted a piece as well. And at the end of the day, it came out with a 0 findings, 0 changes. And at no point in time with this strategy, which is almost unbelievable for anybody that reviews court cases and audits, this is only one out of 2 strategies out there that I know of that has always batted 1,000 and always comes out with a 0 findings and a 0 changes. That doesn't mean that always will. There could be somebody down the road that abuses the strategy. What does that mean? They changed the recipe. They're going to use salt instead of sugar. And of course, the cookies are going to come out different. But as long as you use the counselors and the advice given here, as well with other people we can introduce you to, we will keep you within the guardrails, and you should have the most predictable that is possible, the most predictable outcome that is possible, and retain your deferral of an otherwise very taxable sale.
There's Jake Miller, the Jake Miller, strategictaxsolutions.com, strategictaxsolutions.com, and he's a certified financial planner. He's also an entrepreneur, real estate. He's got it all. He really does. He speaks multiple languages, served in the Army. Love the Jake Miller. Thank you, Jake. So let's dive into a couple other objections you might be curious about. And we're going to be just kind of light on this. We just talked about the first one. The DST sounds amazing, but I need my trusted advisor to say yes before I move forward. I don't understand how my CPA doesn't know about this. That's usually, we've kind of covered that. And the other one is I'm not. It's the passive, and I'm an active guy, right? I'm not a passive investor. I want to be able to own and manage my own deal or run my own business. I'm going to bet on myself every time. It feels like the deferred sales trust is I'm giving up all control, right? And I have to be retired to do this, and it's just not true. And in fact, you can go to my YouTube channel and you can check out Shay Pope's story and how he sold a $2.6 million business, deferred the tax, and then was an entrepreneur with the capital, partnered with the trust, and built 72 multifamily units, all tax deferred in Tennessee, not using a 1031 exchange. And that's the beauty of this. You can do that. That's another objection. The other objection is it's just too expensive for the ongoing fees. We want to teach you how to get the deferred sales trust to work in your favor and become an investment, not an expense. And the way that we do that is by planning with you, understanding your risk tolerance, understanding your cash flow needs and desires, understanding the impact and the freedom you want with the capital, and also bringing in a team to give you different perspectives on different timings to invest in different things. Because guess what? Real estate is starting to shift. Stock market has shifted, let's say probably a year ago at least. And there's different times to buy things at different prices. And that's the beauty of the deferred sales trust, to diversify, to buy at optimal timing. In fact, we're starting getting calls on multifamily deals that are finally dropping in value, that are 25% less than they were, 6 months ago. And the sellers are finally starting to deal. And this is like, we've been waiting for this. In fact, most of our stuff has been liquid. Most of the capital in the deferred sales trust for the last 24 months has been liquid for this exactly, or at least semi-liquid, and lending funds that can get out pretty quickly. And we've been waiting for this moment, and now it's here. And what an opportunity to take advantage. We believe the DST was created for times like this. And if you want to learn more about this, of course, go to capitalgainstaxsolutions.com and schedule a time, talk about how you saw us here online, so we can also bring in the Jake Miller or the Jake Carpenter to talk more as well. Let's see here. What else, guys? Or maybe we can open it up for people. We have Douglas, we have Claire, we have biz accountants, we have Francisco, we have Kathy, we have Micah, Maria. Anyone has any questions or thoughts, you can put it in the chat. You can also, even better, unmute yourself, say hello, talk with us. And we are happy to answer questions and to give you some encouragement and some confidence in the DST.
Hey, Jake, how are you, man?
Good, Douglas. We got you here. I was hoping to say hello.
I just had a question. Maybe it might be redundant, but I'm going to ask it anyway. In terms of the deferred sales tax, right? So how long are they deferring the sales tax for? And then when is it going to be due to the clients?
Yeah, so I'll hit on that, and then Brett, feel free. Typically, we set these up with a 10-year schedule. So think of like a mortgage. There's a first piece of the deferred sales trust that you need to understand. This is an entity we set up right away. And in the beginning, there's nothing inside of it. So we have to put whatever you're selling inside of the trust. We exchange a promissory note, a 10-year promissory note. You exchange that for the item that you put into the trust. So let's say you're putting in a house in Palo Alto that's worth $8.3 million. It might sound familiar. We've talked about that before. You might originally own that in your name. So you have to transfer it to the trust. And you have to do it in such a way that doesn't incur a transfer tax and isn't taxable to begin with. We do that by exchanging it with a promissory note. And that's usually a 10-year note that, just like you can with a mortgage on a house or anything else, you can refinance at the end of 10 years. Now, there are some best practices that will guide you through the life of the trust post-transaction. But essentially, we have clients that Todd Campbell, the founder of this process 27 years ago, that are still utilizing a trust that they set up 26, 27 years ago. So if that helps you, if that helps answer your question, how long can this be going for? A lot of it just depends on the clients, what their situation is, what their needs are. Some people just want this to be a spending plan so they can sell off into the horizon, and it's kind of like a retirement plan, a retirement spending over time plan. Others want this to be part of their legacy. And so there are ways that this can pass on. You can be growing assets out of your estate for other people after you're gone. Does that help?
Yeah, I guess it does a little bit. The question, in terms of, because it's deferred, right? Just like, an IRA or 401k, which means eventually it's going to be due. So does it mean in 10 years, if I don't renew the trust contract, then when I want to start pulling income, then we pay taxes on the income we're taking out? Or what does that look like?
There is something else to recognize. When the transaction is so big, there will be a requirement of taking so much out every year, kind of like an annuity.
Got it.
And then you would have taxes due on that amount that's coming out as if, at the same type of tax rate as it was going in, type of a thing. To your point, though, yes, these are deferred dollars. We're not eliminating taxes. We're not erasing or avoiding taxes. We're telling the IRS that for taxing purposes, this year, we have not recognized that income because we've put this trust in between us and the buyer. So we actually have not taken constructive receipt of those funds, and it's not taxable. And we're able to do that and kick the can down the road. And there's a number of different ways that we can legally and ethically kick the can down the road further and further and further, though typically individuals do take some money and pay some taxes throughout.
Okay, and the taxes that we're paying, is it on the trust tax bracket or on the individual tax bracket?
Great question. Now, this is a business trust, and there are scenarios where the business trust may pay taxes if we don't help you manage everything correctly, right? That's why we're here. Ideally, though, the business itself, the business trust, is not, if we guide you correctly, it's not paying taxes. It's when you take a distribution from the trust out to you or your estate, that at that point you would be paying individual income or capital gains taxes. And under most scenarios, I want to say 99.9999%, it's always capital gains taxes that comes out, except for the money that is allocated to that promissory note interest payment.
Got it. Okay, cool.
All right. And I'll say some of the same things twice here, just so everyone can hear. So how long can you defer capital gains tax with the DST? Well, the answer is you can defer it for as long as you'd like. However, you do need to take some interest payments. So interest is after the principal. So let's say it's 10 million in the trust and you're a married couple, you defer to 4 million and you have $800,000 of cash flow coming off the trust and interest payments, right? It's an 8% interest rate. On that 8%, you'll pay $800,000 in ordinary income tax, right? That'll be a 1099 for 800,000. You'll pay tax on that 800. That 10 million, you haven't touched it, right, Douglas? So if you haven't touched the 10 million, guess what? There's zero tax that in that given year. Well, how long can you keep this 10 million just sitting in the trust and not touching it? For as long as you want, in 10-year increments. So every 10 years you can renew for 10 years. And guess what? Well, eventually you're going to die. We're all going to die. Then the kids can step into your shoes. And so it can be a part of your living trust. And the kids can continue to keep the taxes deferred, live off the $800,000 of interest, which is what most people want to do. And in fact, they might not even need the 800. They might say, I only want 400 and let the other 400 accrue inside of the trust and build up and build up. And so it's not only a delayed tax strategy, it's also a deferred or delayed income tax strategy or income strategy. It's kind of like an IRA, it's kind of like a 401k. And like an IRA, there's no required minimum distribution. However, we like to see some payment come out at a certain time, but this can go on for generations, right? And this is why it's a legacy play that's really unique and flexible for individuals like almost nothing else, because it's a business trust. It's not to set up just for retirement. It's really set up for as a business. And how long can businesses go? Well, for as long as this business are going to be in operation and doing business. And that's the beauty of this. So Douglas, great questions. Thank you for interacting. Let's see if anyone else has any other questions. I see Biz Accounts. That's a cool name. And I'd love for you to jump in and say hello. We see Francisco. We see Micah. Micah, hello. Happy Friday to you. But Biz Accounts, if you want to unmute yourself, you could ask your question or have your thoughts.
Here we are.
How are you, sir?
Doing great. How about you?
Well, I'm doing fantastic. And what's your first name?
Walter.
Walter. And where are you calling from?
Las Vegas, Nevada.
Okay. I was just there for a real estate conference speaking on a panel, and it wasn't too hot. It was actually pretty wonderful. But yes. Walter, what's your questions or thought for the day so far?
Well, so far I don't have any questions yet. So I just keep on listening.
Okay. And what do you do, Walter? You said business account. You're an accountant for businesses?
Yeah.
Okay.
We deal with, mostly with smaller businesses, maybe $1 million type businesses.
Okay, great. And you're a CPA, yes?
Nope, just I'm a public accountant.
Okay, just a public. Okay, good. And what are you? Do you sign clients?
I'm just a business owner. I have CPAs and EAs on the staff.
Okay.
And Walter, we've spoken a few times before. I want to say that you also have some of your own real estate and items that you might be selling in the future, right?
That's kind of in the future. I'm thinking of buying something maybe next year around July or so. But I'm primarily thinking, clients come to me at all times. How do I pay less taxes? How do I defray taxes? And capital gains, of course, is part of it.
And Nevada is not as bad because there's no state, but I'm sure you work with clients in different states, right?
Of course, yeah. I've got clients all over the country.
I'm curious, Walter, what was like the client that was the biggest one you could think of? It was selling a business and had all kinds of tax, and maybe you didn't really have a great solution for them. Like, anything come to mind?
Well, I usually always have a solution.
What's your go-to?
That's what I do.
If someone's selling a $10 million business, what's your go-to?
If I sell a $10 million business?
Yeah, they're in California. They have no basis. They've got about 40% tax. And let's just say they're going to sell it tomorrow. What would be Walter's go-to?
Well, obviously, 1031 exchange, it's the other options in it, to defer taxes if they're willing, to keep on going and just building assets.
Mm-hmm. Okay. Mm-hmm. But what if that business didn't qualify for a 1031? What if it wasn't 1031 eligible? What would you do?
I'd have to call you.
Good answer. But yeah, I guess that's why you're here, right?
Yeah, that's why I'm
here. That's a good point because sometimes it gets confusing, but 1031, they've also restricted it more and more. Like it no longer works for business sales, right? It only works for investment real estate, whereas the deferred sales trust works for investment real estate plus business sales, C corps, S corps, LLCs. It works for cryptocurrency, primary homes, stock, public or private, captive insurance, carried interest, GP, LP interest, really any asset of any kind. Just needs to be big enough. 1 million net proceeds, $1 million gain. Right. It's large enough, you qualify. But yeah, those are some of the thoughts. Any other thoughts on that, Walter?
When it gets to that point, you'll be my go-to person.
By the way, I love the accent. What's the accent from, Walter?
Austria.
Okay, yeah. I just watched the Arnold Schwarzenegger special. It's called just Arnold, on Netflix. It's actually pretty good. It talks about all of his, his Austria upbringing and doing all the push-ups in the forest and all this stuff. It's actually really inspiring. It makes you all want to go work out or man,
no,
I'm not working out.
You'll never look like him.
It's just so strong.
Yeah. No. Neither one of us will ever look like him, I'm afraid.
Yeah, there's definitely some God-given talent there. But it was pretty good. All right. Well, thanks, Walter, for saying hello. You definitely brought a great energy to today. Any questions that come to mind for you right now, or just
not at this point in time.
Okay, excellent. Let's bring in Micah. Micah, we haven't heard from you yet. Micah, we've been talking a lot. What's going on in your world over there, Micah?
Just trying to finish up the wonderful world of taxes and the extension deadlines and everything like that. It's a great time to talk about things like this because it's on the forefront of everyone's mind because they are finalizing, if they didn't already back in April, like their taxes, and they're now realizing, hey, maybe I need to do something, or, kind of be thinking about prevention for next year instead of trying to figure out the cure this year.
Yeah, the fire drills, right? It tends to be intense, and everyone wants all the answers now, and it's like everyone's trying to do it. And there's like been the extensions in California with some of the stuff that went on with the fires and stuff. Pretty wild. Micah, what questions do you think someone might have based on what we've been talking today that we haven't already asked?
I didn't catch all of the questions. I didn't, but I would always probably revert back to just what's the process? Like, how do you get started?
Mm-hmm.
What's the next steps? Or how long does it take even?
Yeah, absolutely. Yeah. So we call it building a capital gains tax exit plan. And it all depends. I think it's the know, like, and trust factor, right? And that's part of why we came out with the book, Building a Capital Gains Tax Exit Plan. And we talk about all of those things as well. Jake Miller's in the book. I have a couple chapters, and then we have like Kevin Harrington from Shark Tank in the book. And we're just trying to make it so simple for you. But it all starts with an eligible transaction, which means $1 million net proceeds, $1 million gain. If you have that, great. You've passed the first step. You can apply for a no-cost consultation call. We jump on for 30 minutes, 45 minutes, and we just walk through that. S Corp, LLC, C Corp, partners, debt. Is there any debt over basis? What is the adjusted basis? What state are you in? What kind of capital gains tax? We're just basically defining and taking all the facts, kind of like showing up to your doctor for a visit, right? And the doctor is going to do some initial screening, and which leads into the next step, which is like maybe you're going to get like a blood test or an X-ray or an MRI, right? And that's the second call, which is typically with the tax attorney, myself, and like a Jake Miller, Jake Carpenter, and we're going through in even more detail. We're getting even more granular on your case as it applies, and we're looking at the timing of the structure. We're bringing in any folks that you might want to bring in, like a CPA or an attorney, to get a second opinion. All of those things. So now you're in it for about 2 hours. Now, if you read the book, you're in it for about 3 hours, and hopefully you've watched a couple of videos, maybe 4 or 5 hours, and you're getting to know, like, and trust us and the structure and the process. At which point you say, you know what, I would like the option to have this in my transaction. Great. Now, your transaction itself, we need the timing is so important here. You're going to sign a conditional engagement agreement, and we're going to insert the trust into the transaction. By that, we mean a paragraph, right, inside of an addendum. And this gives you the option, but not the obligation, to use the deferred sales trust at the exit. And it's important that we do it in this order, because if you have what's called constructive receipt, where the buyer has removed all contingencies, which essentially means that the deal is just about done and you're going to receive the cash, it's too late unless you're in a 1031 exchange. And then we can save that 1031 if you're working with us prior to and or the 1031 accommodator is accommodating. Don't take that for granted, because most of them do not know us, and or if they do, they don't want to cooperate because we are a direct competitor of them. So just keep that in mind. Okay, so we set up the trust, we've inserted into the contract, and then you do some planning as far as the investments, the accounts are opened up, and then we close into the trust. And that's the kind of the big, I guess, 3-minute version. Micah, do you want to add or subtract anything there?
Yeah, I do. You were talking a lot about just kind of what we have to do on our end. It's really important that the client make sure on their end that they know what they want, how much they want to receive, and when they want to receive it, how they want to pass it to other people, whether they want to use it themselves. Really bring all of those elements all together and really form it and model it and mold it to what they want.
I think that's perfect. Jake Miller, you want to talk about how someone might structure the promissory note, the cash flow, the tax flow, just that, bring that all together in a nice little bow here for us.
Absolutely. So oftentimes the value of the asset you're moving in, that's going to be the value of your promissory note, so that it's essentially a wash. And what goes into the trust can then be sold. You receive the proceeds into the trust. You don't take the money, but sometimes you may want the money. And sometimes the promissory note is extra beneficial because of that, because it has this little interest rate that you can take if you want, just that interest rate. You can take that as annual income every single year. A lot of clients want to leave their principal inside of the trust as long as they can. I mean, at some points we ask them to take a little bit out, whatever, but let it continue to go on and live off of If it's the golden goose, live off of the eggs, so to speak, or live off the interest only. And that's what some people do. Some people want it to be a little bit more like an installment. When we've talked about installments where that's principal and interest, and they want to fully exhaust it over their life because their goal is not to leave anything behind, but to take it all. And you can do that. Others, Brett, they want to leave as much as they can to their heirs. They can do that too. And so how do you structure it? It depends on the client within certain guardrails that we help them stay within.
Perfect, right? And also it's adjustable, right, Jake? I mean, let's just say I might start off saying I didn't need or want any money. At least I didn't think I needed it for 2 years. But then 6 months from now, something happens. Life changes. Can the promissory note be adjusted? Yes, it can, right? It can be adjusted to accelerate payments or even decelerate. You might start out with higher income in the beginning and go, you know what? I don't necessarily need or want. I just got another job or I just got to start another business venture and my income is going back up again. I like to maybe turn off the payments. Can it be readjusted? Yes. And so it's super flexible one way or the other, as long as you're using DST 1.0. Now, DST 2.0, bringing Jake Carpenter here. This has to do with the estate tax. We're going to eliminate the estate tax, which is huge for the legacy. If you're curious about that, you want to make sure you look up how to do this. Just go to my YouTube channel, type in estate tax. So go to Capital Gains Tax Solutions YouTube channel and look up estate tax, and we'll walk you through how the DST 2.0 can eliminate the estate tax like nothing else can. I mean, this is really amazing. It feels like it's almost magic because there's no charity required, there's no gifting required, doesn't give up any of your lifetime exemption, and no life insurance required either. And it's in one day, one sale, to take a sale while you're still alive, we eliminate that estate tax. But Jake Carpenter, it's a little more rigid when it comes to payout, and it's based upon your life expectancy. Talk about that DST 2.0 payout.
Yeah, the beauty is you can remove a large sum of money from your taxable estate, both federal and state estate tax. But it is much more rigid. Once you set it, it's a set it and forget it type thing. It's based on your life expectancy, more like an annuity payout. And it can't really be adjusted at that point. And most of our clients doesn't really bother them that much because they're so high net worth and they've got income from so many other sources that it makes sense to defer, a huge tax bill, sometimes millions and millions of dollars of capital gains tax, and basically just annuitize it over their lifetime so that that chunk of money, for example, one case Brett and I are working on right now, $40 to $60 million business sale. And mid 40s. This couple is in their mid 40s and they have a lot of other assets. So this is a huge, huge tax issue for them. But yes, it is much less flexible, but it removes the assets at closing from your taxable estate. So when husband and wife pass away, that $60 million, maybe grown to $80 million or $100 million doesn't get taxed at that 40% rate. And of course, right now we have about a $24 million unified credit exemption, which could sunset and go away here in a couple of years, could go down to as much as only 12 million. So that is a huge tax issue that this particular couple, nobody brought that tax issue up. Nobody talked to them about the federal estate tax, only the capital gains tax. So there was a lot of value to us being able to bring that up as we were checking their ears, nose, and throat in the initial consultation, like your doctor does in the first visit.
That's a great point, Jake. I almost forgot about that during the call 2 weeks ago, right? They were thinking the stepped up basis was going to solve that. And not only did we bring it to their attention, but number two, it's like the fourth quarter, 10 seconds to go. I mean, they're getting LOIs, it's happening. And with the DST 2.0, it has to happen before the close of escrow. We have to set it up. It's not like you could just sell a $50 million business and go like, oh, I want to move it into the 2.0. Can I just move it over there? No. Can I just sell it to that? No. It takes a third party buyer. So it's like the stars are aligned. You got the buyer for 50 million. You've got your net worth and you're above the exemptions amounts. And you might be selling that one time in your lifetime. And we've got a chance to either fumble the ball, it's in generations to come. That's 40%. Not only is it on that, let's say $30 to $50 million, It's also on all of the growth. Post-close, let's say that 50, they're in their 40s. Let's just use 50 as a round number. They're in their 40s. Let's say every 10 years we can double the money. Not unreasonable, right? 50 goes to 100. Now they're 50 years old, right? Now that 100 from 50 to 60 goes to 200 million. Now they're 60 years old, right? 60, is that right? Then 70 to 80. You get the idea, right? This is quickly becoming generational impact wealth. And had they not known that and had got on the call with us and we could uncover these things and bring it to their attention, not only that, but also have a solution that can be transformational. You know, Jake Miller, you say, well, it's the government's biggest mousetrap, and this $84 trillion is going to transfer. Talk about just how valuable the DST 2.0 is for solving this death tax issue, Jake.
Absolutely. And it's a huge issue, Brett. Anybody that might be over those current limitations as they are today, which are rather high, or should the government or the IRS close that mousetrap and decrease it dramatically, whether it just reverts back to half what it was, which is what it's set to do at the end of 2025, or if they take it down even further, because it wasn't 20 something years ago that it was only 600,000 instead of millions of dollars, right? Or if you're a foreign national, a foreigner with property and assets here in the States, it's less than $1 million right now. In fact, sometimes it's less than 100,000 depending on your circumstance. So regardless of that being said, there's this tax that everybody's forgetting about all the time, and that is the death tax. Moving assets out of your estate right now allows them to grow outside of your estate, which is incredibly important, so that we can limit in the future how much of your estate is subject to that debt tax. We are not avoiding, we are not eliminating it. What we are doing is we're freezing with that promissory note. So Brett, when we do the exchange in the very beginning of the transaction, we take the asset, we put it into the trust, and we exchange it with a promissory note. What stays in your estate is that promissory note, and it's limited by the growth of the interest rate, if that interest rate is not being paid out. Under most circumstances, it is being paid out. So we are effectively freezing, to some extent, the overall assets in your estate, while in the deferred sales trust 2.0, outside of your estate, it could be growing, sometimes doubling and tripling over a few years, and not subject to that death tax any longer.
Yeah, absolutely. It's absolutely amazing. And we want to show you how. Go to capitalgainstaxsolutions.com to learn more about all of this. Micah, anything else to add now that we've added a little bit more?
You know, it really just becomes a no-brainer, in my opinion, because you have on one side a huge tax liability that you're just going to donate to the government. And on the other side, you have a marginal percentage that you share with an attorney instead of half of it just being sent over to the government.
It's a great way to put it. Yeah. Yeah.
You can pay all of it to the government right now, or you can spread it out over however long you want and pay very little.
Yeah. And when we're talking about this estate tax, we're talking about, your kids become the heirs of the DST 2.0. They're the beneficiaries. And that itself is able to, they're able to inherit basically the equity at the time of when you pass away, your spouse passes away, and which is amazing, right? So it's like, okay, 40% death tax versus no death tax on all of the money that went in, plus all of the growth, like that in itself is just amazing. So cool. All right. Jake Miller, if they want to find you and Micah, where can they find you?
strategictaxsolutions.com or alphamarkcapital.com, where many of our DST clients are currently investing, as well as the 800 number, 1-800-773-1848.
Amazing. Jake Carpenter, if people want to find you, where they can find you.
www.carpentercapitalllc.com, or you can call us at 509-396-5292.
Amazing. And if anyone wants to find me, you can go to capitalgainstaxsolutions.com. You can also call 916-886-2986. And check out the book. The book is, again, a hit #1 bestseller. We're really proud of that on Amazon, which is pretty cool. And it's called Building a Capital Gains Tax Exit Plan. It's the proven playbook to unlocking your ideal wealth plan when exiting assets of any kind, highly appreciated assets for yourself and for your clients. check that out. Also, like the YouTube channel, give it one of those, thumbs up, subscribe so you get more of this amazing content. Hopefully you're loving this content. And at the end of the day, start planning, asking questions. We do no cost consultations to help you with all of this.
Hey, Brett, there was one more question that came through.
Oh, go ahead, Mike. What do we got?
Okay. Can the DST donate to a private family non-operating foundation trust?
It all depends. That's a big question there. I would want the tax attorneys to go through that in detail. I can tell you I have not seen that yet. I'm not saying you can't do that, but that private family non-operation foundation trust, I'd want to go to the tax professionals to go through that. And they'd probably also want to look at that private family non-operating foundation trust. There's a lot that's packed in there. So good question, Douglas. If you actually have a live case, go ahead.
Two things that will likely be considered there is just the donation or the transaction directly from one trust to the other, or most circumstances would probably require that the trust, that the individuals who put the asset in the trust, in the deferred sales trust, do a distribution that is taxable, right? Capital gains or maybe the interest on the promissory note, and then the tax beneficial contribution to the family foundation trust would offset that tax. So that's probably the type of recommendation, or some of the mechanics behind what the attorneys would look at is, who's receiving it? Is there a need that one trust donate to another trust? I mean, there's not really benefit there. It might actually benefit you more to recognize a little bit of taxes by taking a distribution from the deferred sales trust and then offsetting those taxes by making this, if it's an eligible foundation, tax beneficial contribution to the eligible foundation personally. And that might be additionally beneficial to other taxes that you have personally.
Okay. Awesome. Thanks, Jake. That was good. That was great. Good question, Douglas. Yeah, I like we're geeking out about this tax stuff. You're getting in the weeds with us, which is great. We love to get in the weeds with you guys and learn more every day. That's why we're doing this together as a mastermind, to sharpen one another and to help one another with all of these things. Because guess what? The government has a spending problem, which means what? We all have a tax problem. We're closing on 33 trillion at some point. I've heard 75% of all income taxes coming into the U.S. government will be paying just interest once it hits $33 trillion, which is just mind-boggling to think about. In the meantime, we have proven strategies that are legal, that work, and we want to encourage you to use every means necessary to defer tax, grow wealth, make an impact for you and your family. That being said, again, you go to capitalgainstaxnews.com. Please rate, review, subscribe, share this so someone could help, and we'll be back again next week, Friday, 10 a.m. Pacific, 1 p.m. Eastern. Bye, everybody.
Bye-bye.